The markets are abuzz with activities today, the 23rd of September, 2024. And it's our responsibility, owing you that much, to bring you all the updates and, of course, to let you in on other ways, as you were, that we can shape ideas that would essentially move the economy forward. This is where we analyze the numbers. This is where we talk about the essentials of the market that affects you and your pocket. Welcome again to Market Insights this beautiful Monday morning, and I'm hoping you are having a fantastic start to the week so far. I am David Chiedu, utterly delighted to be here this beautiful morning. Before we get into the heart of the conversation, because we are going to be talking about Nigeria and what the implications will be for the Fed rate cut. Of course, that one has gotten some global markets shaking in their boots, as you were. But of course, we'll get into the thick of things, the heart of the matter, as they say, in a moment or two. But before then, let's get straight to reporting what happened on the floor of the exchange group for last week, ended Friday, 20th October 2024. Now, at the end of the last weekday of trading on the Nigerian exchange group, NGX, a total of 554,221,558 shares in 8,670 deals, corresponding to a market value of 10,120,583,301 naira 45 kobo were traded. Compared with the previous trading day, that was Thursday, September 19, Friday's data showed a 21% improvement in volume, 55% improvement in turnover, but a 12% decline in deals. Now, the current market's capitalization of the Nigerian Stock Exchange is 56.5 trillion naira. Now, in the aggregate, 118 NGX listed equities participated in trading, ending with 35 gainers and 21 losers. Fitsin Healthcare led the gainers with 10% share price appreciation, closing at 15 naira 95 kobo per share, followed by Maya going up positive 9.98%. Caverton Offshore Support Group went up 9.82%, and PZ Cousins Nigeria went up 9.81%. On the losing side, however, FBN Holdings came out last with an end-of-day price depreciation of 9.98% at 27 naira 50 kobo per share, followed by Northern Nigeria Flour Mills going down a negative 9.96%, and Nigeria Infrastructure Debt Fund went down a negative 9.93%, and Flour Mills of Nigeria went down 9.91%. Now, FBN Holdings recorded the highest volume of 152 million traded shares, followed by Japol and Ventures, Fidelity, as well as UAC Nigeria, correspondingly 27.2 million and 26 million, respectively. Now, regarding the performance of the NGX market indices, the benchmark NGX All Share Index climbed 244.24 points, or 0.25% to close at 98,249.99, representing a one-week gain of 1.26%, a four-week gain of 2.64%, and an overall year-to-date gain of 31.39%. The NGX Insurance Index, the Oil and Gas Index, the Pension Index, the Premium and Industrial Index all performed on the floor of the NGX. And I will take a short break, then we get into the conversation proper. Do stay with us. Welcome back, and thank you for staying tuned. Now let's get into the heart of the matter. We're talking about the US Fed rate cut and its implications for our local currency and, by extension, the wider economy. Now, on Wednesday, the US Federal Reserve implemented a 0.5% cut to its interest rates, marking the start of what many analysts anticipate to be a sustained phase of monetary easing, with projections indicating further cuts, with another 0.5% reduction anticipated by the end of 2024, which is a full percentage point drop in 2025, and also a final drop of 0.5% in 2026. Now, this more aggressive reduction in borrowing costs rather, follows rising concerns about the state of the U.S. job market. Now, in its latest statement, the Federal Open Market Committee expressed greater confidence in inflation moving steadily toward its 2% target. Now, the committee believes that risks to meeting both inflation and employment objectives are now more balanced. Now, given this particular development, many questions have arisen as to what the implications are for the Nigerian economy. We'll discuss this and more on the program this morning. And joining us to have this discourse is a business strategist, corporate strategist, financial analyst, and public policy expert, Mr. Oladetan Oluwatosin Emmanuel. Good morning, Mr. Emmanuel. Welcome to Market Insight. Can you hear me? Fantastic. Nice to have you join us. So, Oladetan, let's start with your thoughts. Now, the U.S. has had ultra high interest rates over the last 4 years. Matter of fact, going back to the era of the pandemic, as you were, because of inflation rate, right now they've raised, interest to contain it. Now we see this decision, as you were, leading to some, the batting of some eyelashes, as he were, across major markets of the world, talking about the UK, talking about Japan, the EU as well, even thinking about doing the same. Now, what are your thoughts on this? Let's start with the fundamentals. Give us a sense of what's really going on in this sphere.
Okay, so basically, US has grown to be the world reserve currency. And when we say the world reserve currency, majority of the transactions carried out all over the world are traded in the US dollar. Of course, we'll see some other predominant currencies such as the Chinese yen, the European euro that is controlled by the European Central Bank, also leading transactions. But after since the Bretton Woods agreement in 1945, US has been the major currency of trade. So that is, if US currency or US as a market sneezes, most economies are likely to catch a cold. Now, the US started increasing the rate since the time of the pandemic, and we could look at what really happened during the pandemic. It was an unprecedented situation whereby there had to be a lot of injections. In fact, the US had to do the US swap, whereby disruptions, whereby people could easily move money and have access to the dollars thereabouts. So if currencies require more access to the dollars, one of the tightening monetary policies that the US could do is for them to continue to increase rates. And ever since then, since the pandemic up to now, we've seen that the rates have risen from what it used to be to about 5.5%, which is predominantly high. So what that simply means is that is going to be having an impact on inflation, is a higher cost for businesses to carry out their operations because the rate is quite high and unprecedented for them and it's not sustainable for them. But since we've seen a bit of stability and other balances within the global space, other economies have also reduced their rate, but in fact, it took so long for the US to reduce their rate, which reduced by 50 basis points, which is about 0.5%. We were expecting that at least, since the inflation rate is like about 2.3% now in the US, at least the interest rate should be just like about the inflation rate plus 100 basis points, like about 3%, max 3.5%. So we still believe that there's going to be a further cut in the interest rate. But another issue to really consider is the forthcoming American election, which is going to be happening in November, which is can also determine or is going to affect who emerges the president of the United States, what is his economic policy, what is we see Kamala and Donald Trump leading across the Democrat and the Republican parties. Both of them have different economic policies, and they might want to drive different economic initiatives. So that's another factor to really consider, despite the fact we expect a further decline in the interest rate subsequently before the end of 2024. Now, what does this mean for emerging economies like Nigeria, developing economies like Nigeria, India,
Can
and the
you
rest
hear
of them?
me, Oladetan?
Yes, I can hear you.
Okay, great. I was going to ask you now, because of uh, because of what's going on, it seemed like there was a little bit of a dissent, if you like, between the chair and the governor per se, because the latter, beg your pardon, seems to think that it'll be better if the cut wasn't quote unquote whole at 0.5%. So she thinks, that's Bowman, thinks it should be 0.25%. Saying that it would have been a much better way to go. Do you share this sentiment? I mean, she's the governor, but then again, in your view, what do you think about this?
So I think the US is trying to be a bit more cautious. Simply around now, we've also seen that with the judiciary today applying a bit of caution as regards providing any verdict on any case. So, for example, inflation rate is like about 2.3% over the last 1 to 3 months. We've seen that majority of the stocks in the market, in the US market, have been on a downward trend. We've seen negative volatilities and prices being affected negatively. So also, we are trying to, of course, we know that 5% is far, far large from what the inflation rate is, but we don't want to just assume that there is an ease. We just want to be provide a bit of stability thereabout. So it's nothing wrong for them to still maintain the rate, but we expect that in line with the economic policies and in line with the way interest rates have been structured, we expect it to be around 3.5 to 4%. But another thing is to also look at economic growth and also the state of employment. We've seen a lot of reduction, a lot of companies laying off their staffs. And if the interest rate continue to be at that 5%, 5.5%, is likely to impact on wages. Simply means that it's going to force manufacturing, going to force the corporate world to increase wages. We've seen that Canada just recently adjusted their minimum wage, which is going to be implemented before the end of this year. And if you are going to be continuing to increase minimum wage or adjust the wages or the remunerations to staff, it's going to lead to another trigger of inflation. So the only way to steepen that inflation and maintain it at that particular level is for them to really adjust the rate downward. So she might just be a bit more cautious that we shouldn't take the bullish one. We're expecting like about a 1%, 1.5% since it has increased up to this level, but we still having it at 0.5% is still considerable and not an overkill for the US economy and the global market as a whole.
Now, back home, we've had some experts, opining that all of what's going on has a higher tendency to influence our CBN's, decision, at the next MPC meeting, as he were, to drive up, inflation, drive up, beg your pardon, interest rates, as he were. So, they're concerned that it might affect their decision at rate adjustment. While that is one fear, some of them also say that it might not exactly be the smartest thing to do at this moment. They seem to think that a pause to that particular action will be a much better way to go, especially as it balances inflation concerns with the need for, economic stimulation or growth, as it were. I mean, only last week we saw our headline inflation dropping to 32%. So, what do you reckon? Do you think, do you share their sentiments as to whether the CBN should pause or not?
So let's look at the locality. So part of the things that the issues we may have as regards the global space, the Fed rate. So as interest rate goes down, that is the cost of borrowing for the US market is also likely to go down. Simply that the return. So the returns that used to be around 6%, 7%, we can see more competitiveness for the Nigerian US bond, the Nigerian dollar bond, which is the $500 million bond, open to about 2 billion, with an availability of a market of about 2 billion target market, which we saw that was part of the things that also increased the foreign investment or the access to the FX. So Nigeria has the $500 bond is trading around $900 million as we speak. Now, also let's also critically look at Nigerians inflation. On the Nigerians inflation side, you've seen that they've been an 18-month rise since December 2022, up to like about a peak of 34.19. Then it has gradually reduced the month of August, we've seen the second decline to like about 32.15. But majorly, what is the driver of the Nigerian inflation? We've seen that the food inflation, which used to be like about 40.17%, 40.87%, has reduced to about 37.52. So we can simply say that Nigerians are a bit hungry. So the inflation rate in Nigeria is majorly driven by hunger. So since and now that the headline food inflation, which is contributing like about 16 to 17% all those while, has reduced to 37.15, we are likely to see that there's going to be the steep on that. Currently, the food inflation is contributing like about 16.65% to the total inflation. But that's not to say that the core inflation, the core inflation, which is the all items of farm produce less the volatilities that we could see from agriculture and energy, because the petroleum has been subsidized, has also been on the increase. So this is not simply mean that the real inflation is driving. And also when we look at the base effect, we've seen that the inflation has been on the rise for about 18 months. That means last year too, it was a bit high. So when we are comparing against last year and the index factors, we can see that it's not really a structural inflation in the economy, but it's as a result of the food index, because the food index makes up majority of the inflation of the CPI, the consumer price index that we use in Nigeria. So as regards the monetary policy rate currently at 26.75, we expect that the CBN is likely to put a pause to it. Now, why do we say a pause? The only reason why the monetary policy rate has been increasing simply was because as a result of increase in inflation. Since we've seen 2 consecutive declines in inflation, it might not be so lucrative or so bullish for the CBN to revert a downward increase. So I'm not likely to see a pause or maintaining at 26.75 or maximum of a 50 basis point decline. And now why would there be a need for the justification of that decline? We've seen that interest rates are 26.75. So if you walk up to a bank, your cost of lending is within 30 to 35%. So how many companies in Nigeria are able to deliver that margin or that operating profit margin to be able to pay back the bank 30% interest in a year? That means within the space of 2.5 to 3 years, you are paying the bank your total capital, right, or which you've taken as a loan. We've seen that the Nigerian banking sector, we know of a particular bank that was able to deliver about the 1 trillion naira as half-year profit, and we've seen others also growing. But meanwhile, if the banking sector is increasing and the profits within there is increasing, the productive arm of the economy, which is related to agriculture, manufacturing, industrialization, are we also seeing that same growth? We are seeing massive decline in that. So I think that there's a need for the CBN to also consider positioning the economy. Based on normal economics, we expect that there should be a pause in the rate. But if the CBN would want to help the manufacturing sector, then they can just reduce it so that it's easier for the manufacturing sectors and the industrial sectors and the productive aspect of the economy to be able to have access to funds that they can use to grow and develop.
Now, earlier you mentioned something along the lines of competitiveness for local businesses. I'm curious as to how that would exactly affect us. The devil is in the detail, as it's said. Now, I'm thinking as the foreign goods become more affordable due to this particular development, it surely would be perceived that it would have some adverse effects on businesses, especially when you're considering things like profitability and market share. So I'm wondering, help me out here. If I can get those goods or get some services, as you were, cheaper when I do import, why do I have to source locally? That's just a question on the minds of some people. Can you help clear that up?
We should not forget that even as we speak, the the foreign exchange is still managed indirectly by the CBN. So about 1 month, 2 months ago, we had the retail Dutch auction system, which is managing whereby the CBN can trade to the local market. The foreign exchange in Nigeria is still a managed foreign exchange system. It's not a free float based on the market of demand and supply. So if it is not a free float based on the market and demand and supply, what the CBN can do is that the CBN can ease their intervention of the management of the foreign exchange. So we saw that the external reserve have increased to like about 37.31 billion, which is like about a 12% increase based on what it is as at the beginning of this year, which is like about 4.03 billion increase. So if the CBN is coming to manage at that point in time, like the retail Dutch auction and the wholesale Dutch auction system will be seen, and there is a bit of ease, then what the CBN is likely to do is for them to ease off their management of it. So we might not likely see that real impact in the FX. So currently, as of today, we're seeing that the FX is trading like about above 1,500. Last week it was trading above 1,600, about 1,600. Thereabout. So meanwhile, if you look at the purchasing power parity of Nigeria to the dollar, that is, you compare the prices of goods and services traded in Nigeria and traded in the US and other part of the world, it should be like about 1,200. It should be about 1,000, between 980 to 1,000 thereabout. So I think the Naira is still significantly undervalued. If it should be at 1,000 and it's trading at 1,500, 1,600, it's significantly undervalued. And we need a lot of supply, and the only way we can get much of this supply is for us to be able to actively export or actively trade or exchange the goods and services we have in Nigeria for the dollar. Now, if we are not, the productive arm of the economy is not actively doing that, so agriculture or manufacturing is within 4% to 4%, within that 4% range, crude oil and natural gas is about 92%. So if crude oil and natural gas is still at the core of Nigerian exports, and we've not been able to even move manufacturing to like about 10% or agriculture to like about even 15%, then I don't think it's going to be easy for the CBN for the prices for us to reflect that lower prices, except the CBN. The only thing that can bring the dollar down to like about 1,000 is if the CBN actively intervene through a Dutch auction system. If not, even without the CBN intervention or the CBN management, the exchange rate should be like about 2,000, getting to 1,800 to 2,000 within that particular window. Hence, the CBN finding a way to intervene in that. Thank you.
Earlier, you were talking about some interventions by the CBN, and I quipped in before we went on that momentary break that some analysts and experts alike had before now hinted ideas along the lines of having our currency subsidized. What do you reckon? Okay, so basically, that is not the bullish approach to take. The more you continue to subsidize your currency, the more you continue to create a lot of intervention schemes for your currencies, the weaker your currency gets over the long run. However, Nigeria, as we speak today, the Nigerian Naira is still a bit subsidized. So part of the things that accounted to the 4.1 billion, 4.03 billion increase we've had this year is as a result of the 2.5 billion loan from World Bank, and also like about the some fraction of the 3.0 billion oil deal with Afreximbank, NNPCL with Afreximbank. But what can make a currency stable over the long run is active export. So basically, we look at the balance of trade. Nigeria have had the Q2 2024, that is, we've had a balance of trade surplus. Now, balance of trade surplus simply means that we simply exported much more than we imported. Now, why did we have a balance of trade surplus? It's simply because the cost of importation is lower. Is so high that people cannot really import. Now, we've seen a lot of manufacturing companies and a lot of companies leave the Nigerian market simply because it's quite
competitive and it's quite not easy to carry out businesses. So if you continue to subsidize the currency, you continue to create a bit of intervention, you're only going to be playing a second place to the global market. You cannot take that leading position. The only thing that can help you to take that leading position is for you to invest in the productive aspect of the economy. You need to invest a lot in technology, and you also need to reduce your budget deficit or your debt to international organization. I think Nigeria is still at a very is at the brink of economic collapse if we continue to expand our foreign debt the way we are currently doing. 2.5 billion from World Bank and other foreign loans is not sustainable for the economy over the long run. The more we continue to expand our foreign debt profile, the more we continue to, or the more we are forced to play along to those.
All right, Oladetan Oluwatosin is still with us on the conversation. That little glitch we will sort out. But we are talking about the US Fed rate cut and its implications for Nigeria. Can you hear me now?
I lost you for a while. I couldn't hear you. I lost you for a while. I couldn't hear you. Can you hear me clearly now?
Yes, I can hear you now. You want to wrap up your thoughts so we can go on?
Okay. So I think what is going to make, rather than continue to subsidize the Naira with respect to other foreign currencies or with respect to the dollar as a means of trade, I think what Nigeria should really do is reduce their foreign debt and also find a way to increase exports and make Nigeria a source of destination for foreign direct investment and foreign portfolio investment. That is going to make the Naira stronger. But if we continue to subsidize the Naira by several intervention schemes and all that, it's not going to be sustainable over the long run, and we're only going to be playing the second place where we're not able to make Nigeria or the Naira strengthen or gain that economic relevance as other countries have gained in the world. Thank you.
Just talked about foreign direct investment, and I reckon that is one of the very many advantages that this could mean for us following what's happened at the US Fed, including, capital inflow, as you were. Now, as far as this is, this particular development is concerned, what will be the trickle-down effect? So as far as these advantages, if you like, are concerned, what will be the trickle-down effect to the, final consumer, I beg your pardon, the average Nigerian whose hope on a daily basis is just to be able to feed? I'm curious. Can you help me clear that up?
Okay, so we said that over the last month on month, the foreign direct investment has risen by 0.03 billion. That's more or less like 100% to like about 0.06 billion. That's like about 6 million. Foreign portfolio investment have also increased from about 0.2 billion to like about 0.6 billion. Now, if we have foreign direct investment, that is, they are investing in Nigeria, we are seeing a lot of funds coming into the Nigerian space. It simply means that we have access. The pressure on the demand for the US dollar is likely going to be less, and simply means that you should actually make Nigerians productive. And people could have access to funds and develop and increase our exports. Now, if the investments it also depends on the kind of investment. Of course, we've seen that a lot of investments are coming into the Nigerian soil, are going into the services. Simply that is where they have the best returns. In fact, the Nigerian all share index, we are seeing like the banking stocks is like about 60% of the all share index, contributing a significant portion of the all share index that we have in Nigeria. And we cannot develop a nation by just services. You need to focus on the productive aspect of the nation that can able to drive industrialization. I think Nigeria still need to go through that industrial cycle whereby we need to increase our export. We cannot continue to, how many Nigerian banks are able to even export their services out of Nigeria? Likes of Paystack, likes of Flutterwave that have moved to other markets are just a few. So the only major thing that we can increase or advance our development is for us to be able to export the increase activity within the productive arm of the society. We are not able to do that, irrespective of what we are just likely to see from these foreign direct investment and foreign portfolio investment. Is just a little balancing or a little adjustment to the economic state, which is not sustainable for the organization over the long run. And also, it simply means that they've invested. We are not seeing foreign equity investment. We are seeing foreign direct investment in debt. That is after they've invested in it, after they get their particular returns of course they're going to fly out back. So for example, the US rate is like about 6%, and the Nigerian foreign portfolio Nigerian dollar bond is 9.25%, and the Nigerian treasury bills is like about 20% within that range. So if I convert, if the FX is a bit stable within 1,500, I bring in $1 million, which is like about 1.5 billion, and I invest it in a 1 year bill, and I earn 20% of it. That's about 1.8 billion, and I convert it back. So I've made a greater return. So it's not something that is going to develop the economy over the long term. It's just for people to be able to make short-term gains. So I think what is more or less important to Nigeria is foreign equity investment, and the investment that is going to develop the active sector of the society, rather than things that for people to just bring in their money, or I call it more or less hot money. People to bring in their money, and when they get their returns, they fly back out of Nigeria.
You just talked about short-term gains, as you were, and that would ring true on some, or rather in some regard. Now, I'm thinking about it from a more personal perspective right now, and I reckon there's a number of people who will share my sentiments. Now, I have dollars in my possession. What do I do in the immediate term, given what's going on? Do I sell right now? Do I buy right now? Or do I keep it or hold on to it with the hope of, El Dorado tomorrow? What are your thoughts?
It actually depends on the CBN body language. So if you look at it over the last 3 years, the dollar have devalued by about 30% yearly. So if I have dollar now and I expect a further devaluation of the dollar, the best thing is for me to just keep it, right? And buy more now, so that by the time it devalues further to, let's say, 2,200, I'm able to sell back to the Naira and I'm able to make more gain. But if the dollar is relatively stable as it is, of course, we cannot say further interventions by the CBN, but I think the body language of the CBN now is to manage the dollar at 1,500 or 1,200. Of course, if I expect the dollar to be around that 1,500 and 1,200, the best thing I can do is for me to invest in the Naira now, and over the next 1 year I get like about 21%. But if I get like about 21% and I convert it back in 1 year time, so it all depends on the volatilities. But I will not expect anyone to take a very long position. I will expect you to take probably like a 2-3 months or maximum of a 6-month positions, and for you to be able to which you can easily leave the market. So, but I think most people now are investing in the Nigerian dollar bond, which is the $500 million bond, which has like about $900 million now, which is an average of 9.25%, which is significantly above the rates you could get in the US market and all that. So that's quite interesting. If someone have dollar, why not invest in that now? But if I expect a further devaluation, that the Naira is going to devalue from like about 1,500. So within last year, as at the end of 2023, Naira was like about 800 to a dollar. Now, if devalue over 100%, and I have the dollar now, what I just need to do is just for me to hold the dollar now and expect a further 100% devaluation from like, let's say, 1,600 to 3,000. Of course, I convert it back to Naira, I'm able to make that gain. But if based on the interventions of the CBN, I expect there should be a bit of stability within it over, but don't hold too long positions, just hold short-term positions for you, and as you're able to manage your portfolios better rather than holding a 1 year or 2 year or 3 year, which is, I think, is too long.
The fact that there is some attention for the dollar bond, as you were. Now, me, just like most other Nigerians, in fact, I'm actually very, ecstatic that you did that. But we're still worried about the risks attached. Now, are our fears or concerns valid, or do we just go for a more safer option, which is the Euro bond, as far as this, development is concerned? I mean, I'm curious. It's a head-scratching moment for me at this point in time.
So basically, the dollar bond, because it's in Nigeria, issued by the federal government, the Debt Management Office of Nigeria, more or less like the federal government, and also is issued in foreign currency, so we can call it an Euro bond. I don't think there's a bit to worry about it. So currently, the external reserve is around 37.31 billion. And it's just like we don't have up to 2 billion. They are eventually going to be able to pay back and settle both the principal and interest as at when the only thing that might happen is they just deplete the further external reserves. So, but why do you want to keep something for 5 years and just be earning 9.25%? Are there no other productive things that I can invest that money in? If I don't have anything to do with the dollar, of course, I can just simply keep it there. But I still believe that there are a lot of productive aspects or mind opportunities within the Nigerian space. Especially within the manufacturing and the industrial spaces in Nigeria. We've seen the local sourcing of petroleum and it's in Nigeria now. So we could see the likes of petrochemicals, which I should be able to get of that particular percent. So basically, we are going to see that the CBN does not want the FX to devalue beyond 1,600 over the short term, and they are putting everything possible in place. So I naturally think the FX should be about the 1,000 within the 1,000 window, 1,000, 1,200. So I think what is appropriate as an investor, depending on the size of fund. If I have large funds of millions of dollars, I would just rather invest in the productive arm of Nigeria and see how I can make more export, ensure that my export is majorly in US dollars and is more or less relatively stable. So if I'm able to invest in things that Nigerians can really export, I think I'm going to be able to get the best out of it rather than just keeping it and earning just 9.25% over the long 5 years. In fact, whereby the inflation in Nigeria is even about 32.15%, 9.25%, 32.15%. That disparity is just too much for me to just get my money there. I would rather invest in the productive arm of the society and be able to earn higher returns on that and be able to maximize my wealth.
Now, let's prognosticate just a little bit. In your view, do you see, based on current events, of course, do you see our FX, attaining stability of some sort long term? And I put long term within the range of 18 to 24 months. Do you see that happening?
It's going to be positive for the CBN to achieve that. And the only reason why the CBN be able to want to achieve that is simply because they want to attract foreign direct investment, FPI and FDI. The moment you're seeing further devaluation on the FX, of course, this money that we call out money are also going to find its way out of Nigeria. So the CBN want to attract more funds, and the only way we can attract more funds is for you to have stability on the FX or even have a further appreciation in the FX. So the CBN is of the best interest of the CBN to avert further devaluation of the Naira. But if you are going to leave it without further intervention by the CBN or by the monetary policies bodies, by the CBN and other monetary policies drivers, regulators in Nigeria, is likely going to devalue further. If you just leave it based on market and supply or free float, it's likely going to devalue further. But with the CBN wanting to devalue further, no, they are not going to want to. They don't want that further devaluation. They rather want an appreciation of it, and the only way they can do that is for them to continually manage the position. And also, we see that the CBN is looking at a $1 trillion economy over the, some people have said over the next 3 years, some people have said over the next 10 years. But the way things are going, we are not going to be able to achieve that $1 trillion economy if we continue doing things this way over the next 5 years. Remember, the banking recapitalization program is also on ground to ensure that as of 2026, all banks are able to get have a revised capital threshold so that they're able to manage the activity of a $1 trillion economy. So I think the CBN will want to cause a little bit of stability within that particular range, but I think the Naira is significantly undervalued, and the only way we can do that is for us to have more supply because the demand is not going to reduce. In fact, we're likely to have more demand. We should have more supply through export, foreign direct investment, and foreign portfolio investment. But I don't think it's sustainable for the CBN to continue, or the fiscal arm of Nigeria to continue to take foreign denominated debt like the federal government, World Bank debt, and the IMF debt that we are currently exploring.
Now, as far as public and private sector spending is concerned, what do you see as being the implications of the recent development on those?
Based on the recent development, private sectors are likely to there's likely to be a further decline in interest rates for the public sector. So we are likely to see more activities in the private sector. Also for public sectors too, we are likely to see more expenditures. We are likely to see more spendings within the public sector because it's now more or less stable or cheaper to source funds, which naturally should lead to an expansionary monetary policy. So we're likely to see more expansion, which will further advance growth and development within Nigeria. But we also need to be a bit of caution, exercise a bit of caution, and not expect that those growths are just likely to continue over the foreseeable future. How long do we want to see this ease? And what are the other sectors? It's not just monetary policy that is affecting a business. Is of course the business is affected by both structurals and all that other factors. Currently, not all private sectors, and in fact, not every arm of government have been able to implement the 70,000 naira minimum wage. Simply some are clamoring because they don't have enough funds and all that. And also, what is the profit that the businesses have been able to make? How many businesses are able to increase their profit by geometric projection or have a two-digit rise in profit, which we are not seeing within Nigerian space. So I think over the short term, we are likely to see a bit of relief. Then within the next 6 to 12 months, we are likely to see a bit of economic rebound thereabout if this continues or we see further easing of the monetary policies rate.
Well, thank you very much. It has indeed been delightful talking with you this morning on the program. Oladetan Oluwatosin Emmanuel, business strategist, corporate strategist, financial analyst, and public policy expert. Very many thanks for joining us on the program this morning. We do appreciate your time. This has been Market Insights. Today we've been talking about the US Fed rate cut and what it does mean, or if you like, the implications for the Nigerian Naira and the wider economy. Much has been said about the other global markets, as you were, following suit. And of course, us here being an emerging frontier market, what we're going to do about it. I mean, as we talked about earlier, the advice by a lot of analysts, including our guest today, has spoken about the CBN, holding off, if you like, on moving on with a potential rate, increase, as you were, the next MPC, and also speaking about the advantages of what's going on, the global market, more capital inflow for Nigeria, more FDIs, as he were, and a more competitive market, which is also worrying some local businesses, wondering whether or not they will be better off for it by the year. But of course, with gazing eyes and fingers crossed, we watch and see how all of it plays out in the market, in the here and now, and of course going forward. And that's Market Insight today. But before we go, we will take a look at what it looks like on the floor of the currency market, both at the official and at the parallel market. Today, Monday, the 23rd of September, 2024, the official market seeing the dollar exchanging to the naira at 1,628 naira, to the pound sterling at 2,200 naira, and to the euro at 1,849 naira. And elsewhere, at the parallel market, the naira to the dollar trade is 1,639 naira, to the pound sterling 2,176 naira, significantly lower than the official market. And of course, the euro is trading to the naira on the parallel market at 1,819 naira. That's what it looks like on the currency market. And that is our overall package for you today on today's edition of Market Insight. Many thanks for joining us. Do stay close to your set, because in a few minutes, that will be, of course, at the top of the hour, it'll be time for the news update. And of course, you want to join us later on at 3 p.m. for the major news bulletin. And of course, in between, some interesting programs that, of course, would tickle your fancy. I am David Chiedu. Until tomorrow, have a wonderful day.